Today we're going to go over a process that I use for swing trading. Now, it's a process that I've been putting together for years, and it's based on experience. It's based on talking to really good technical traders. It's based on reading books. It's just based on years of experience. Now, this particular method is what I use, and it's certainly not financial advice. It's just to give you an idea of different ways to look at charts and technical analysis to increase the probability of a successful trade. Now, normally I do swing trades because they're short-term trades in a retirement account because I don't want the tax implication. If you do this in a regular investment account, you're going to have some short-term capital gains, so keep that in mind. So let's go forward and look at some tools that I use, and then we'll set up a chart, and then we'll look at some different scenarios of swing trading. So let's get started. So the first question we have to ask is, what is swing trading? According to Investopedia, swing trading has been described as a type of fundamental trading in which positions are held for longer than a single day. Traders attempt to capture short-term profits by using technical analysis to enter into positions, hold for several days or weeks, and exit soon after. Most fundamentalists are swing traders, since changes in corporate fundamentals generally require a short amount of time to cause significant price movement to render a reasonable profit. The style of swing trading lies somewhere between day trading and trend trading. So then we need to pick the right stocks for swing trading. So the first key to successful swing trading is picking the right stocks. There are two key variables to consider when choosing the stocks to swing trade: liquidity, which means how much volume buy and sells you have, and volatility. So the best candidates are large cap stocks, which are among the most actively traded stocks on the major exchanges. In an active market, these stocks with high transaction volume. If a stock has poor liquidity or doesn't have deep action in the broker's trade book, it may be difficult to sell or may require substantial price discounts to relinquish the shares. So you can also do index funds too. You can trade the Qs, you can trade the S&P and the Dow, and they have plenty of liquidity. Some of your smaller cap stocks will not have the same amount of liquidity as your large caps. And finally, volatility is really a swing trader's best friend. Without price movement, there's no opportunity to make a profit. While volatility is often thought of negatively, swing trading relies on volatility to create an opportunity to capitalize on the appreciation of a stock's price. The stocks that have the highest volatility may be the most ideal for swing trading, as there's the most opportunity for profit. So swing trading is a lot easier in a bull market than it is in a bear market. And swing trading strategy is different under each environment. So bear market swing trading is more difficult for natural buy and sell trades. In a downtrend environment, equity market prices are decreasing in the long term. Therefore, it's not advantageous to buy a security and hold it with expectations of price appreciation. Of course, you can always do the shorts, ETF shorts, but those are also very risky and highly volatile moves to make. There are several strategies for the bear market swing trading. One option is to shorten your trading period. So instead of holding for weeks, just go and have a quicker turnaround on your securities you're holding. You could trade on the hour. You can trade on the 45 minutes to 15 minutes instead of the day. Or you hold more cash, so plan on holding back some capital you may otherwise be trading in the event that securities you're holding suffer declines. Or you convert to options by buying puts. So those are some strategies you could have in a bear market. Bull market trading could be easier as prices tend to appreciate during these market conditions, so it's easier to buy a security and experience a profit in a short while later. However, there's a few things to keep in mind when swing trading during bull markets. First is entry points are higher, so after liquidating your position and capturing profits, chances are greater that general market securities are now more expensive if broad markets have appreciated, so you'll be paying higher prices for securities. And also you form bad habits. It's said that bad trading habits are formed during bull markets. Continue to do your due diligence and market research on the best securities to hold. While it may seem like every security is a winner, this won't always be the case. So let's move on to some of the tools and how we set up our charts. So the first thing we're going to do is build our chart for swing trading. And this is, again, not financial advice. This is how I do it. So we're going to use the SPY, this Spider S&P 500, as our stock that we're going to track. The first thing we put in is the 200-day simple moving average. Now, the 200-day moving average is represented by this line on this chart, and it's the average price over the past 200 days or 40 weeks. Okay, the moving average can give us as swing traders a sense regarding whether the trend is up or down, but also identifying potential support or resistance area. And the 200-day and the 50-day moving average are sometimes used together with crossovers between the two lines considered technically significant. So basically, if you're above the 200-day moving average, you're in a bullish trend or a bullish market. As you can see, going back here, we went back 10 years to 2012. We are in a bullish, trending market up until the point of about August of 2015, where we went into a bearish trend below the 200-day moving average and then we came back out about March of 2016. That continued up for about another 37% until we hit again the 200-day moving average on this SPY index, okay, and that was around October of 2018, and this lasted until approximately February of 2019. Again, we had another upstretch, and you can see the 200-day moving average is also used as support and resistance. This case here, it's support. When we came up into this area, again, this was the pandemic. We had a steep drop underneath the 200-day moving average, and that lasted until about May, so about 3 months, where we came above it, and again, the index continued to separate from the 200-day moving average up until this point, approximately in January of 2022, where we started our downtrend. Now we're below the 200-day moving average. The 200-day moving average is rolling over a bit, and we have a trend on daily price action actually rising back up to the 200-day moving average. So if the price action is above, you're in a bullish trend. If it's below, you're in a bearish trend. You could actually trade this if you wanted to just on this. If you were in the SPY, getting out at this point, getting back in at this point, getting out at this point, getting at this point. A lot of people use this strategy in their ETFs to make sure they don't get into an extended downtrend where it could take, like it did in the Great Depression, 26 years to get back to even. So I actually use this strategy myself. I used it in January, actually in December when I saw the downtrend, and got out of most of my long-term ETFs at this point and went to cash. From that point, I did some swing trades. I do swing trades underneath this line. When this line gets back above the 200-day moving average, I'll move cash back in and can re-establish my positions in these indexes. So now we're going to add the 50-day simple moving average. You can see it here is the white line. And this works in unison with the 200-day simple moving average. And as this 50-day crosses to the lower side of the 200-day, that is called a death cross. And that is referred to as signaling an upcoming bear market. So you can see the price action goes down. And when it crosses back over, that's considered a golden cross, and that considers a bullish market. So you can see up here, come down, we cross. So the 50-day moving average is another important metric that we use in our swing trading criteria. The 50-day simple moving average is a trend line that shows the average of 50 days of closing prices for the stock plotted over time. The 50-day average is considered the first line of support in an uptrend or the first line of resistance in a downtrend. It's also used as an indicator, like on an indices such as the S&P 500 is. 75% of the S&P 500 is trading above the 50-day moving average, or 75% is trading below the 50-day moving average. It shows really a bearish or a bullish market, depending on which you're looking at. So together, the 50 and the 200-day moving average are important moving averages for us as swing traders and as investors. So the final simple moving average, what we're going to use, probably the most important when it comes to determining when we buy or we sell, is the 9-day simple moving average. Now, some people use the 10, some use the 13. For me, researching this over several years and talking with people, I've found the most success with the 9-day moving average. The 9-day simple moving average is a trend line that shows the average of 9 days of closing prices for a stock plotted over time. So it's a lot closer. It's a smaller moving average, so it shows a lot more volatility. So together with these three moving averages, we're going to be able to do some swing trades. Now, there's a few other things that we need to add to our toolbox, and mostly they're oscillators. And so let's add those to our toolbox before we start learning how to swing trade using this system. So we have our chart here, and this is the SPY, and we can see that we have lined up our SMAs. There's our 200-day simple moving average. Here's our 50-day simple moving average. Here's our 9-day simple moving average, and then we also threw in the 20-day EMA. So we have all our moving averages on, but we're going to add 3 more tools that I use to help me decide whether I'm going to initiate a trade or not. And the first one is the RSI, which is the relative strength index. So we're going to come up here and we're going to add the RSI. Pretty easy to do right here. You see the RSI is now down here. So the RSI, the relative strength index, it's a momentum indicator used in technical analysis. The RSI measures the speed and magnitude of a security's recent price changes to evaluate overvalued or undervalued conditions in the price of that security. So the MACD is the moving average convergence divergence and it's calculated by subtracting the 26-period exponential moving average, the EMA, from the 12-period EMA. The MACD triggers technical signals when it crosses above to buy or below to sell at signal line. So here we've added the MACD. The MACD is the red line right here. This is the signal line. So as I look here, we cross below the signal line, indicating that price action will be going down. You can see the price action is going down. We can also use the histogram here to show a running up of the price action, and then when it's reversing. You can see when it reversed here, we started going down. A lot of people use the MACD as a trading tool alone, just like they use the RSI. When it crosses below, they sell. When it comes over and crosses above the signal line, they would buy. So again, we come down, we see that the MACD in this particular example of the SPY crossed over about at the end of June and stayed above all the way until present. So the MACD is just one other tool that we use in unison with our other tools to determine when to buy or sell. So the last tool I'm going to use is called the slow scholastic, and you can see it's added right down here. And basically I have two lines, the percent K and the percent D. And the percent D is basically your signal line, your percent K. And these are very close to the MACD. However, the slow scholastic measures the relative position of the latest closing price to the high and low over the past 14 periods. When using this indicator, the main assumption is that the price of an asset will trade near the top of the range in an uptrend and near the bottom in a downtrend. So this is something I like to look at because it seems to actually be ahead of the MACD. So it gives me a little bit more of an indicator of which way the market's going to go. So when the slow scholastic crosses, you normally see that the MACD is not crossed. So you can see right here it hasn't crossed. The slow scholastic has crossed. When we come down here, you can see we've crossed again. The MACD is not. This gives me a better, quicker indicator on which direction the market's going to go. So let's move on to some charts and see how we use all this together to do some swing trades. So I've learned over a long period of time of investing and trading that you should have guidelines that you follow just to make sure that you're consistent in how you evaluate stocks or ETFs or your investments in general. So I have guidelines for my long-term investments, and then I have guidelines for my swing trading. And this is just from studying different people, studying different books. And this was what works good for me. So this isn't financial advice for sure, but this is the guidelines that I utilize. So if you're going to do swing trading, you should find your own guidelines that fit within your trading style and your risk tolerances, and maybe write them down. I have these on my wall so I can see them at all times. So let's just go through my swing trading guidelines. So we want to look for stocks that have price action pullback and then a sign of recovery. So we'll show an example of this. But basically, a stock that has been pulled down and then is reversing. We want to see stocks with high trading volume. We don't want to get stuck with a smaller stock that has no volume because then you won't have bids or asks on either side. It's going to be hard to trade in and out. We want stocks with positive trends, uptrending SMAs, and we've already gone over SMAs. Stocks trading above the 200-day SMA. Now, this is just because I want to be trading in a positive, bullish market, but again, these are just guidelines, and sometimes I go outside of my guidelines. The RSI showing positive momentum and usually above the 50 and heading up. The MACD crossing the signal line in a positive direction is something I look for. I look in the slow scholastic, the percent K line crossing percent D line in a positive direction. And I look for one full candle close above the 9-day SMA. And I usually trade in the daily format and not the hourly or the weekly. So be aware of stocks with upcoming earnings and dividend payouts because those can affect your swing trade. So I try to get out of a swing trade before earnings. And I also am very cognizant of dividend payments because the dividend comes right off the stock price. You can swing in several time frames like we've talked about, from the 1 minute to the weekly to the monthly charts, the yearly chart if you want. However, be sure that whatever time frame you buy in, so if you're trading in the daily, it's the same that you sell out of, so you trade out of the daily. Don't get attached to a stock. If the trade goes bad, get out. You don't want to be holding these things long term and get down 50, 60, 70%. This is not long-term investing, remember. So the most important thing I can say is be patient. You don't always need to be in a trade. You can sit out, and sometimes I'm out for weeks, maybe a month at a time on swing trading, looking for the perfect setup. Learn how to swing trade through paper trading. So don't just start with your own money. Just kind of do it on paper and see that you get the hang of it first. And it's a process, and as the more you do it, the better you're going to get. So let's not just start out with your own money. And lastly, this is how I swing trade. There's no guarantee of success. I've been doing it, and I've had good trades, I've had bad trades, but mostly good trades. So feel free to develop your own system. And remember, this isn't financial advice. This is just how I do it and trying to give you some ideas of how maybe you can set up a potential for how you swing trade. So let's go ahead and take a look at some different setups and see how they fit to my guidelines.